Mortgage rates in the U.S. are on the rise. They are at their highest levels since 2009.
The average for a 30-year loan jumped 0.1% last week to 5.2%. The current average, a borrower with a $300,000 mortgage would pay more than $1,600 a month. That is $377 more than it would have cost at the end of last year. Big difference. The increase in borrowing costs are pushing buyers out of the market. Joining us now is Mike Fratantoni. He is the chief economist and senior vice president of research and industry technology at the Mortgage Bankers Association. Thank you for being with us. On a scale of screwed to really screwed, how bad is it out there for first-time home buyers?
Yeah, I think you captured it correctly in terms of the numbers. So mortgage rates up more than 2 percentage points compared to this time last year. Home prices are up about 20% nationally compared to last year at this time. You put that together, our data shows that in March, the typical mortgage payment, a little more than $1,700. That's up $80 from February and up, as you said, about $400 from the prior year. So you think about how that increase in payments impacts potential applicants. For a person who already owns a home, they've benefited from this increase in home prices. They've got a substantial amount of home equity they can put towards a move-up purchase. But for a first-time home buyer, it's really challenging seeing this rapid increase in rates, rapid increase in payments. At the same time, we've seen rents go up just about 4% in the first quarter of this year, and rents are up double digits compared to last year. For a first-time home buyer, it's a real tough choice between continuing to rent, with rents increasing as fast as I was saying, or sort of taking that plunge and seeing these mortgage payments increase as well.
Either way, your monthly payments are going up significantly. So, Mike, as you know, the Federal Reserve raised interest rates about 0.5 point last week. How could that continue to impact mortgage rates?
So it's not a direct connection. So the Fed is targeting a very short-term and overnight rate, where for most people, a 30-year mortgage is a much longer-term instrument. Markets are forward-looking, and so financial markets have already really priced in the expected path of the Fed over the next couple of years. So we think we may be near a plateau in terms of mortgage rates, and they might even come down a bit as we get into 2023. You know, that said, we still expect home prices are going to continue to rise over the course of the next year, but at a slower pace than we've seen over the last year.
Mike, can I just follow up really quickly on that? Because you say the markets have pretty much priced in this interest rise, but some people are saying the markets haven't, and that's why we're seeing all this volatility, because they actually don't know exactly what to make of it.
Yeah. So, you know, you got to commend Chair Powell and the rest of the folks at the Fed. I think they did a particularly good job at this last meeting last week, communicating both their plans with respect to where they're going with short-term rates and also the behavior of their balance sheet. They're beginning to allow some of these longer-term assets to roll off. So I think markets have the information they need now to be able to think about, you know, where short-term rates are going in the future. The big uncertainty here is what's going to happen to the economy as short-term rates go up. You know, we think the job market, which is as strong as it's been in 50 years, we see the unemployment rate going even lower over the next couple of months. So down to something like 3.3%. Wage growth is very, very strong. So even though payments are higher and there is this stress to affordability, households are in very, very strong shape. So I think, you know, the Fed is taking the moves they need to combat inflation, which has really become ingrained in this economy. But we think overall the housing market's going to be able to plow through the challenges that are in its way.
So if you're that average American sitting at a $900 rental right now at the kitchen table, it's 3 a.m., you're trying to make the numbers work, you want to buy a home, you've been playing by the rules, but you just can't, and you're frustrated. Help me understand where a person who hears about all these abstract things like the market this and the rate points that, where do they place that frustration? Who's to blame for a middle-income American doing all the right things, not being able to get a home right now?
Yeah. So I think home buyers are going to look to this situation that is challenging, particularly for those first-time home buyers. And there's really 3 responses they could have. You know, one is really casting a wider net. You know, maybe looking a little bit further out, accepting a longer commute to be able to buy that home, or in some cases, moving to a lower cost area of the country. And we're seeing a lot of that. A second thing that they certainly can do is tighten in their budget a bit. So, maybe they were looking for a single family detached home. They might shift to shopping for a condo. We're seeing some of that in the market. The third approach that a potential home buyer could take to make it a little easier to get into this market is, instead of going for a 30-year fixed rate loan, to go to an adjustable rate loan. So there are a lot of ARM products where the first 5 or 7 or 10 years, it's a fixed rate, and they adjust after that. In exchange for that flexibility, the borrower gets a lower rate up front. So those are the 3 ways I say those potential folks sitting around their kitchen table adjusting to this environment of, indeed, higher mortgage rates, high home prices, challenging affordability, but there are adjustments that can be made, particularly in a world of hybrid work where people may be willing to accept a little bit longer commute.
Those are great points, Mike. And we don't have time to get into it now, but I would just point out that it's not only first-time home buyers who are locked in. You might own a home and you've got equity that's gone up, but because everything else has gone up, even if you cash out, it doesn't really get you anywhere you want to go. So it's challenging for a lot of people out there. Mike Fratantoni, thank you very much.
Thanks for having me.